Well, will the coronavirus cause a housing crash, much like what we saw in 2007 and 2008? And is it a good time to be on the market, or should I pull my house from the market? And is it a good time to buy, or should I wait for that crash and buy later? And what's happening to interest rates? Um, these kind of questions and a few other concerns are the things that I've been hearing over the past 2 to 3 weeks. So in this April 2020 housing update, I'd like to try and answer some of those questions for you, give you some information to help you answer it for yourself. And I'll give you my opinion as well, which the short answer is no, I don't think so. So in order to do this, I'm going to use a little bit of newly learned technology. And I say newly learned because it's not new, but it's new to me. I'm going to do a screen share with you and show you a lot of the data and the information that I'm looking at that helps inform me about what is happening here in Kitsap County. Now, I'm also reading and listening to an awful lot of the national news, and there are about a half a dozen what I will call gurus, people who are at the national level and paying very close attention, and whom I believe really understand what's happening in the market. And I'll give you a little bit of insight about what they're saying as well. It's not a whole lot different than what I'm thinking for us locally. We're just a little bit more accentuated, I guess, a little bit more. We're following those trends a little bit more strongly. So let's get into it. I'll swap you over here and you can take a look at a little bit of statistics. So this is from our MLS. You can see that I've selected Kitsap County and that we're looking at residential and condominium units, any size, etc. And this is for the whole county. Now this includes Bainbridge Island, and I don't normally include Bainbridge in my statistics that I'll quote you guys when I say, hey, there's so many houses on the market. I don't normally include Bainbridge. And the reason for that is Bainbridge Island tends to follow and reflect the Seattle market far more closely than it follows or reflects the rest of Kitsap County. So I tend not to put it into the data. But nonetheless, the curves are going to look very much the same. The numbers are just a little bit smaller. Now you can see this is what homes are actively for sale month by month. Okay, and over the past 3 years, you can see from 2017 to 18, we had a little bit of a reduction in inventory at the peak. 18 to 19, we had a pretty big reduction in inventory at the peak. And of course, through last fall and winter, we had a reduction in inventory as would be normal and as is expected. Bottomed out, looks like in January, about 341 units. Now for the excluding Bainbridge portion, we did get down last month in February to a point where at one day, we only had about 225 units on the market altogether. That's any price range, any condition. Now, you notice that we started to come back up a little bit in February, a lot more in March. That tends to be holding true right now. So the last several weeks, and I pay attention to the number of houses on the market in Kitsap, excluding Bainbridge, pretty much daily. And I've watched it grow from that 225 number up to about 340 today. And that's continuing to creep up. That's normal. And the median asking price is creeping up with it, and that's pretty normal too. But so that's what's been happening over the last 3 years. Pretty normal curve. I anticipate, and it was my anticipation, it still is, that this curve is going to continue and that we're going to top out close to where we were last year, maybe a little under, maybe a little over. But inventory is still very challenging for us. That's why buyers, you've been feeling what you're feeling. Seems like everybody's competing for everything, and that tends to be true. So inventories are low, and they're staying low. But that doesn't mean things aren't selling. There are a number of houses coming to the market. It's just that they're also selling. And you can see this is the pending units each month. So how many units go under contract. And when we compare this with the new listings that hit the market, that's then what makes the difference. We have more houses hitting the market right now and in the spring typically than go under contract each month. And that's why that inventory starts to climb a bit. But you can see the past couple of years looks very similar to last year as well. had a reasonable number of houses selling. And what you really want to look at is the area underneath these curves from a January to a December. That tells you the total number of houses sold and has been pretty consistent. What's been happening is the fact that we've not been able to keep up with that whole number each year. There's not enough new construction happening to sort of offset that. That's why those inventories are going down. But in any case, you can see that, yes, we had fewer sales over the winter, and that's normal per month. January, February, we came back up. March, we came back up quite a bit. Now, in the last 10 days, so 11 days since the beginning of the month, we have had 88 units go under contract. So you multiply that by 3, that's about 264 units for the month. And when you notice, that's not a whole lot compared to what was happening, but it's more than happened in December. So the question becomes, is that part of the coronavirus effect? To a certain degree, yes, but it almost has more to do with inventory than it has to do with the coronavirus. And you'll notice the past couple of years, in 2019 here and in 2018 here, we do get at least 1 month in the spring, in that spring run-up, where we end up having a bit of a downturn. So that's pretty normal. So that looks like that's probably going to be April this year. Now, why it moved to April and why we tended to get a stronger February and March than we normally do, that's a different discussion subject, and it's a little bit lengthy, but suffice it to say that it has to do with technology and people trying to beat the curve and so on and so forth. So in any case, it looks like a fairly typical spring, and I think that that's going to continue. So to get back to the question of, is the coronavirus going to cause a housing crash? I said my short answer is I don't think so. Let's take a look at why I say that. And the first thing we have to do is understand, well, what caused that crash back in the day? There were 3 things that were occurring, 3 underlying components that basically led to the crash when we had an event like the coronavirus happen. I call it pulling a thread on a tapestry. There was this incredibly complex tapestry that was woven, and one thread got pulled and the whole tapestry came apart. And it was because of how it was woven. In other words, the underlying basics of the market. So let's look at a couple things. So we were looking at houses for sale over the past 3 years, right? Well, let's look at it over the past, say, 14 years. And let me move my head out of the way. You can see that prior to the bubble busting, our inventories were low. That's true. And in fact, they got down to as low as about 680 some odd units at the peak. That's not much inventory, but compared to today, that's a ton, right? Well, you can see that even as we were having the bubble in 6 and early 7, we were getting more and more and more inventory. So our inventory trend was going strongly in the up direction, and we had a lot of it. In fact, we had so much of it that we were oversupplied. We'll look at that in a second. But you can see once the bubble busted, and that happened in late 07, and so then 07 and in 08, we hit some peak inventory. 12 years later, we've done nothing but go down, 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 down. And it looks like that trend will likely continue until we really put the gas pedal onto some new construction. And that's starting to happen over the past couple of years. I'm real pleased with that. But in any case, we had a pretty big oversupply happening at the time when we had our last bubble busting. Okay. Now we can also take a look at the month's supply. And what that does, it gives us an idea of not just the inventory, but the absorption rate as well. And that's pretty critical. So let's take a look at that graph over the same period. So month's supply, this is based on how many houses go pending each month. And you can see that back in the height of the bubble, we had about a 3.2 month supply. And it was starting to go up from there, and it just crept up, 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 up. This is part of what led to the busting of the bubble. By the time we hit late 07, we had a 9-month supply. That's huge. That is very much a buyer's market. And it wasn't exactly behaving as a buyer's market, but it should have been. There was a lot of other factors that were in there about why it wasn't, but it wasn't. So compare that with today. We're down to last December, a 1-month supply overall. a 0.9 month supply in January and February, and we're back up to 1.1 months now. That's almost no supply. So we were oversupplied at the time the last bubble busted. That was part of the problem with the bubble. We were oversupplied. So that's factor number one, and we're not oversupplied today. So another thing to look at is over pricing or pricing altogether. So price per square foot. Now you can see here that the average price per square foot also saw a spike right at the end, right before the bubble busted. Now, if we could take this graph back further, which I can't, the system doesn't let me, but my memory goes back further. And since I've been doing this 23 years, I sort of remember. If you took the height of this market and the dollars per square foot and you tracked it back over 20 or 30 years, you were going to see that the average growth was about 4.5 to 5.5% a year, which is much higher than what the typical growth would be. Normally we get about 3.4, 3.7% on average over the years. Now, if you take today's same number, so we're at an average price per square foot of $243 per square foot. And I like using per square foot because it adjusts for the size of the homes. We tend to build bigger and bigger homes each year. So price per square foot's a little bit more of a better understanding of what's actually happening to prices. But if you take this 243 and you work it backwards and you look back 20, 30 years, I did this, I took it back to 30 years ago, and you look at the trajectory, we're right at about 3.5% year over year growth. That's very normal. So we're right about where we're supposed to be. We're not overpriced. We're not oversupplied. Now, the other thing that was happening right before the bubble busted, and I don't have a graph to show you this, is that there were a lot of investors in the market, and they were buying up a bunch of stuff and then turning around and selling it for, especially new construction, and turning around and selling it before they ever lived in it. They would close on it, turn around and sell it for a profit. And so they were removing a lot of inventory from the market and then putting it back on the market at a higher price. So they were driving prices higher artificially. They were cutting into the inventory that most buyers should have had to select from. And a little bit of that's happening today, or has been happening today, was happening in some markets today. And those are the iBuyers that you may have heard of. If you don't know what those are, give me a shout. We'll chat about it. I'll tell you about it. But the iBuyers in today's market sort of take the place, in my mind, of the investors that were in the market right before the last bubble busted. Now, they're not in all markets, and so there's a difference, a distinct difference, and it's an important one because it means that each of our local markets is going to be less affected or more affected depending on whether iBuyers are present. And in Kitsap County, they really aren't yet, and it's I think it's sort of doubtful that they will get a strong hold here, just because our numbers and our market doesn't lend itself to their model, to the way they do business. They would be taking on too much risk trying to operate in Kitsap County. So we were overpriced, we were oversupplied, and we were over-leveraged. Back when the bubble was happening, right back here in 06, 07, and 05, man, people were taking equity out of their house like it was a bank. And I don't have the graphic for you now, but you may have seen it in one of our posts, a few months ago. But when you look at how much equity the average homeowner had at the time the bubble busted and compare it to today, it is worlds different. We are not over leveraged. We are not upside down on our values. So there's a big difference as well. If you want a really in-depth understanding of what drove the bubble and then what caused it to bust, there's a great book. You may have heard me recommend it before. It's called All the Devils Are Here. And it's a long read and it's tedious, but boy, you get a clear understanding of what really happened and who the players were. In any case, so that's some data to back up why I think, no, we're not going to, the coronavirus is not going to cause another bubble, another bust. So you've also heard me say, though, that it feels to me eerily like we're in 2001. I think that's very true. And everything is a cycle. You've heard me say that before. Housing is a cycle, and it will go through another cycle, and there will be another bubble and a bust. The question is, where are we in the cycle? From everything I can tell, from everything I can feel, the behavior of the buyers, the behavior of the sellers, looking at the inventory, looking at the month's supply, looking at prices, looking at interest rates, which right now are tremendous. They're still in the threes, which is unheard of. Gosh, back in the bubble when we were having all this business, they were in the sixes, So interest rates today are just phenomenal. But I look at all of that, and to me, what I see and what I feel is that we're just at the beginning of that bubble. Now, the last bubble started in about 2001. We had had a little bit of a softening, and rather than having a rollover in the market and in the values, and rather than having a bit of a drop in prices that would have occurred over a couple of years, what we had instead was a reacceleration, and that was due to what some of the Fed policy was and what they did with the economy and began to lower those interest rates. We had been up in the 7s, 8s, they started dropping it down into the 6s and 5s and so on. Anyway, that and the investors drove that last bubble. What's driving it this time? Well, once again, we've got the Fed trying to keep interest rates low and drive them even lower. And we just had in 2019, let's take a look at our price per square foot again on a little bit shorter time scale. Let's look over the 3-year period here. You'll notice that in 2019, we had a bit of a dip here, okay? And that's a little unusual. It flattens out, but it doesn't always get this volatile or dip that much. And you look at that along with the lower inventory and the lower volume of sales, and I thought what I was feeling was a flattening of the market. And it really started in 2018 right in here. Let's look at about a 5-year span. And you can see how flat this went, and then 19 was very volatile as well. So I was thinking, okay, great, we've had our up. We're about where we're supposed to be on prices. We're going to have a drop off, and that'll be fine. And if you'll remember back in September of 18, August, September of 18, interest rates did pop up about 1.5%, and that really killed the market for about 3 to 4 months. And I thought, here we go. We're going to start catching up on some inventory, et cetera. And we had seen on the homes for sale, remember we had seen in 17 versus 18, that we had seen just about the same amount of inventory. In fact, at one point, I thought we had just a little bit more inventory. So I thought, good, we're going to start recovering inventory. We'll get back toward a more balanced market, et cetera. That didn't happen, obviously. And you can see that in 19, things reaccelerated. And that was in large part due to the monetary policies that the Fed has got in place and what was happening with the interest rates. And it brought more buyers out of the woodwork again. So those things all feel and look very similar to 2001, 2002 to me. So I think that's where we are. I believe we are at the beginning of what will be another fairly large acceleration in prices. I think our inventory is going to struggle for a few years still. And I think that eventually it will bust, but not for probably 3 to 5 years, give or take. And in the meantime, prices are going to go up, 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 up. And interest rates are probably going to stay low. When they try to raise them, they slow down the market, and they don't seem to be, they being the government, the Fed, and so on, don't seem to be willing to let the housing market slow down and catch up with itself in any meaningful way. So that's what I think I see coming. So then the other question is, so then how does the coronavirus play into all that? What's it really doing? What kind of effect is it having? Because certainly it's got to be having an effect, right? Well, it is. And so part of that is what we talked about with April looking like the sales were going to be a little bit slower. Now, part of that is also just low inventory because compared to last year, let's take a peek here. So in March, we were at 387 units. Last year, we were at 406. The year before, 396. So we are a little bit lower than we were in 2019, and certainly lower than we were in 2017. So overall, our inventories are still tracking down. So there's that. Then there's the fact that we're probably going to have even less inventory coming onto the market because there are some people who are going to not be able to or choose not to sell right now until this thing blows over. For instance, we've got some military members who were going to put their house on the market, but now they're not going to because they're not getting transferred for another 2 or 3 months beyond what they thought they were getting transferred for. So they're going to wait. That makes sense. We've also got some clients who are ready to put their house on the market, but they need to get some work done, and they're not in a condition to do the work themselves. They need someone to come and do it. They need to hire contractors to come and do it. And of course, the contractors can't do that right now. All they can do is work that's emergency work. So they're not going to come to the market either. So we will have fewer sellers and fewer listings than we might have had otherwise. We're also going to have a few fewer buyers than we might have had otherwise because the response to all of this from the feds did create quite a bit of turbulence in the mortgage market. Now, they've put some mechanisms in place to try and smooth that back out and undo some of what they did unwittingly. And what they did unwittingly was start to buy up too much mortgage-backed security, and it threw things out of whack. Anyway, what that means is it's going to take a little while before rates really stabilize out and things get back to normal a bit. But as a result of all of that volatility, what we're seeing is a lot of lenders are putting additional requirements on some loans. And so they're getting a little stricter. They've pulled back a little bit on what they're willing to loan and to whom they are willing to loan. So we've got a number of clients who were qualified to buy. Now all of a sudden they aren't. Now they're probably going to be again in just a little while. Give it 2-3 months. They'll be qualified again. This will blow over and we'll be back to normal. But meanwhile, fewer buyers. So we'll have fewer buyers, fewer sellers. So we will have fewer sales. Don't mistake that to mean that, oh, gee, the market's dying, it's crashing. It's not. When we get released back to work and all this unemployment stress goes away, because it will, then we're going to get back to business as normal. So what I think that means for us here in Kitsap County, I think it means we're going to see a little bit of a second spring when those sellers who can now sell decide to go ahead and get back into the market. You're going to see another surge of new listings, which we should be experiencing now, but we're not. And then those buyers will also come back into the market. And so we'll see another sort of a secondary spring bump. We've already seen some this year. We've already seen prices coming up. When we look at price per square foot again, you can see that from December we were at $238. Now we're up to $243. So we've had a little bit of an upward swing in prices. And we'll have another pretty good upward swing once we get through this and the market gets back to a bit of normal again. So I hope that all makes some sense for you. I know it's a lot of graphs to take in and a lot of information to take in, but the bottom line is, in my opinion, the market's fine. We're still seeing lots of competition on just about most everything in the affordable range. Oh, speaking of ranges, let's take a look at that. So this is March, even though we were shut down for a week completely in March. And we're back to not exactly business as usual right now, but we can show houses under some strict protocols, and appraisers can do their thing and inspectors can do their thing. So we're back to working and back to showing houses and writing offers and so on and so forth. But let's take a look at March. So this was March for Kitsap County, and look at the price ranges. Now from 0 to 250, that's pretty much fixers for the most part. There's some habitable units under there, some condos and a few lower price, smaller homes that are habitable. But for the most part, those are fixers, etc., which explains why they aren't moving quite as fast. Only 70% of those are going under contract in the first 30 days. Only 70%. So between 250 and 500, though, is where the bulk of all of this activity is occurring. It's what I'm going to call the affordable range, or the normal range for most home buyers. And you can see that at 250 to 350, 87% are under contract in the first 30 days. And from 350 to 5, 82%. So between 250 and 500,000, over 80% of what hit the market went under contract in the first 30 days. Even above 500, from 5 to 750, over half of them went under contract in the first 30 days. And from 750 to $1 million, how about that? 2/3 of them under contract. It's not until you get over $1 million that we begin to have what might be considered a somewhat balanced market. Everything below that, look at the month supply. In the 250 to 350 range, we have about a 10-day supply on the market. So very short supply. And things are moving very quickly and very good. And if we were to look at the sale price to the listing price, let's take a look at that percentage of list price. You can see that we've been on average about 100%. We bumped up in 18. That makes some sense. Dropped back down to about 100%. I can tell you that the prices that are, or the places that are priced well, are typically going over their price. We've written or been involved in offerings on about 22 different properties this year, 23 different properties so far this year. And some of those we were representing buyers, some of them were our listings. Out of those, only 3 were not in competition. The rest were. So that's the kind of market it is. It is still a very strong, very hot market. I believe we are at the beginning of our next bubble. We'll see if I turn out to be right or not, but you know what? It sure feels the same to me. And I started this a year ago. I started saying, oh my God, this feels like 2001 because of the behaviors I was seeing, the things I was feeling. One of the key components, multifamily homes, duplexes, fourplexes. I remember the beginning of that last bubble, those prices had gotten to be what I considered stupid. They didn't pencil. They didn't make sense. As an investment, they did not make sense. So for a number of years, I didn't help anybody buy anything. It just didn't make any sense. And sure enough, the bubble busted. It came back on the market at a reasonable price. And myself and a number of my clients picked up a bunch of them and did quite well with them. So I'm beginning to see that already again. Within the last year and a half, I started seeing, man, these prices on multifamily just getting to the point again that they just don't make sense. Ding, 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 rings a bell. Anyway, that's one example. That's my opinion. Hope all that makes some sense. Would love to chat with you more about details. If you have a question about your specific area, your specific price range, call me. Let's discuss it. I can break these stats down to much tighter areas, South Kitsap, or just, South Kitsap on the west side of Highway 16, or the east side of Highway 16, or just Bremerton, or just Paulsbo area. But if you want a more accurate indication of your area and your prices, and or as a buyer, what your options are, give me a shout and we'll get you handled. Thanks a bunch. And until next month, I hope it didn't bore you to death. Thanks. Bye.